Let's be honest, most people know investing is important, but many still avoid it. Not because they're lazy, not because they hate money. It's because investing feels confusing. People worry, what if I pick the wrong stock? What if I lose money? How do I even start? Here's the good news. You don't need to pick stocks at all. There is a much easier way to invest, and that's by investing in funds. Today, we're going to break down, in the simplest possible way, what a fund really is. Mutual funds, index funds, ETFs, hedge funds, and which one might be best for you. By the end of this video, you'll understand investing better than most adults. Let's get started. Section 1. What a fund really is. Before we compare different types of funds, we need to understand what a fund actually is. Let me explain using a simple story. Imagine you're hungry, and there are 4 snacks on the table. Cookies, chips, candy, crackers. Each snack costs $2, but you only have $2. If you buy one and it tastes bad, well, your money is gone. So you ask 3 friends to put in $2 each. Now you have $8. You buy all the snacks and share everything. If one tastes horrible, no big deal. You still enjoy the rest. That's how a fund works. A fund is a pool of money collected from many people to buy a large mix of investments. Instead of buying one stock like Apple or Tesla, your small investment gets spread across many stocks at once. For example, if a fund invests 20% in Apple, 20% in Google, 20% in Tesla, 20% in Microsoft, 20% in Nvidia, and you put in $5, then your money automatically spreads across all 5 companies. You buy one fund. You instantly own many companies. This gives you diversification, lower risk professional management for some funds. Now that you understand the basic idea, let's look at the different types of funds and what makes each unique. Section 2. Mutual funds. The first type is mutual funds. A mutual fund collects money from many investors and hires a professional fund manager to make investment decisions. The manager's job is to study companies, buy and sell stocks, try to beat the market. This is why mutual funds are considered actively managed. Someone is constantly adjusting the portfolio. Pros of mutual funds: professionals doing the work for you. Good for long-term investing. A wide variety of strategies. Cons: higher fees, usually 0.5% to 1.5%. Higher minimum investments, $500, $5,000. You can only buy or sell at the end of the day. Some famous actively managed mutual funds include Vanguard, VP Max Fidelity, FBGRX, T, Rowe Price, TRBCX. Mutual funds can also be passively managed, meaning they follow an index. When that happens, they're called index mutual funds, and we'll talk about those next. Section 3. Index funds. Index funds are one of the simplest and most beginner-friendly investments in the world. Instead of hiring a manager to pick stocks, index funds simply follow a list. An index. The most well-known index is the S&P 500. It includes 500 of the biggest and strongest companies in the United States. An S&P 500 index fund automatically buys all 500 companies. No guessing, no stock picking, just following the list. Examples include Vanguard, VFIAX, Fidelity, FNILX, Schwab, SWPPX. Why are index funds so popular? Very low fees. Extremely diversified, great long-term performance. Very easy to understand. If you believe the US economy will grow, you believe the S&P 500 will grow. That's why index funds are often recommended for beginners. Most investors who want a set-it-and-forget-it strategy choose index funds. But index funds come in 2 formats: index mutual funds, index ETFs. And now, let's dive into ETFs, the fan favorite. Section 4. ETFs. Exchange-traded funds are one of the most flexible and popular fund types today. They work very similarly to index funds, but with one big difference. You can buy and sell ETFs anytime during market hours, just like a stock. This makes them extremely convenient. Why investors love ETFs? Very low fees. Usually no minimum investment, easy to buy on any trading app. Instant diversification. You can trade anytime. Popular ETFs include VOO, S&P 500, QQQ, NASDAQ 100, tech heavy, VT, entire global market SMH, semiconductor companies. And yes, there are actively managed ETFs too, such as ARKHE, but most ETFs are passive. Think of ETFs as the modern, flexible version of mutual funds. For most beginners, ETFs are often the easiest starting point. Section 5. Hedge funds. Now let's talk about the most mysterious type of fund, hedge funds. Hedge funds are not for regular investors. They're only for wealthy individuals and big institutions. Minimum investments can be $100, $250, even over $1 million. Why so high? Because hedge funds use very aggressive strategies, such as short-selling leveraged derivatives, high-risk trades. They aim for extremely high returns, but they also take extremely high risks. Examples include Bridgewater Associates, Citadel, Millennium Management. Unless you're already wealthy and comfortable with big risks, hedge funds are not necessary. Section 6. Which fund is best for you? So now that you understand all 4 types, which one should you choose? Let's break it down. If you want maximum flexibility, ETFs. You can buy them anytime, even with small amounts of money. If you want simple, easy, long-term growth, index funds. They are low-cost, diversified, and historically very effective. If you want professionals actively managing the money, actively managed mutual funds. Good for people who believe certain managers can outperform the market. If you are ultra-wealthy and want high-risk strategies, hedge funds. But for most people, these are unnecessary. Section 7. Performance. Which one makes the most money? This might surprise you. Most people assume active mutual funds or hedge funds would make more money because they hire professionals. But in the United States, over long periods, index funds often outperform most actively managed funds. Why? 2 main reasons. 1. High fees eat into returns. Actively managed funds charge higher fees. Even a 1% fee can drastically reduce your long-term gains. 2. Beating the market consistently is almost impossible. Some fund managers outperform the market for a few years, but very few can do it reliably for 10 or 20 years. This is why many investors prefer S&P 500 index funds, low-cost ETFs. These tend to grow slowly and steadily over time. Conclusion. Let's summarize everything. Mutual funds professionally managed, higher fees. Good for long-term but limited flexibility, index funds. Follow a list. Low fees, great for beginners. Reliable long-term performance, ETFs. Trade anytime, low fees. Very flexible, beginner-friendly. Hedge funds. High risk. High minimums. Only for wealthy investors. For most people, especially beginners, the best options are low-cost index, funds, and ETFs. They're simple, diversified, and historically strong performers. And that's the complete breakdown of mutual funds versus index funds versus ETFs versus hedge funds. If you found this video helpful, make sure to like, subscribe, and comment which topic you want next. Thanks for watching, and I'll see you in the next video.